Bitcoin just suffered a brutal 30% collapse in a single month, and this is not some random shakeout. A whale has been feeding Bitcoin into Binance again and again, and almost every time it happens, the market gets hit. Not nudged. Hit. Another wave of coins moved in, fear exploded, and now traders are asking the one question that actually matters. Is this the bottom, or is this the beginning of something much uglier? Because behind the chart, behind the candles, behind the headlines about healthy corrections and normal volatility, something more dangerous is unfolding. One giant wallet has been acting like a wrecking ball in a market that was already weak. Investors who bought the breakout are underwater. Billions in losses are already locked in. Confidence is cracking. And in a market built on emotion, once confidence starts to break, price can fall a lot faster than people think. What makes this so dangerous is not just the size of the sell pressure, it is the timing. This is happening in a fragile market, the kind of market where bad news does not stay small. It spreads. One heavy transfer becomes panic. Panic becomes liquidations. Liquidations become forced selling. Forced selling becomes another leg down. And suddenly what looked like a dip turns into a full-scale wipeout. For the last few weeks, traders have been watching the same pattern repeat. Coins move to Binance. Price reacts. Analysts flag it. The market stumbles again. That pattern has been strong enough to turn one wallet into one of the most watched addresses in crypto. Not because people love wallet drama, because in moments like this, one large seller can become the trigger for an entire chain reaction. And this is where most people make the mistake. They focus only on the whale. They think the whale is the whole story. It is not. The whale is the spark. The real danger is the structure of the market it is landing on. This market was already filled with weak hands, late buyers, nervous leverage, and investors who came in near the highs believing the easy money phase would last forever. It did not. Now those same buyers are staring at red portfolios, broken momentum, and a chart that looks worse every time they refresh it. That is why this moment matters so much. We are not just watching Bitcoin go down. We are watching pressure build inside the system. Realized losses have surged into one of the biggest loss events in Bitcoin history. That means this is not just paper pain. This is not just people feeling bad while waiting for a bounce. This is actual surrender, actual losses being locked in, actual capitulation. And capitulation is where markets become dangerous, but also where they become interesting. Because when people finally break, when hope starts evaporating, when traders who swore they would never sell begin smashing market orders just to stop the pain, that is when a market gets close to a turning point. Not always the final one, not always the clean one, but a turning point. The problem is that capitulation can either mark the end of the worst damage or just the first major crack before something deeper. That is the battle right now. Short-term holders are taking the pain. These are the buyers from the last few months, the people who entered after the breakout, after the headlines, after the excitement. They bought strength. They bought momentum. They bought the dream of an unstoppable run. And now they are the ones paying the bill. Many of them came in at levels that now look painfully far away. Every drop feels personal. Every failed bounce feels like betrayal. Every day they stay in the trade, the pressure gets heavier. Long-term holders are different. They have seen this before. They remember the earlier crashes, the periods when Bitcoin felt broken, the moments when everyone declared the cycle dead. They understand something newer investors often do not understand until it is too late. Bitcoin does not usually reward comfort. It tests conviction. It drags people through fear, doubt, and exhaustion. And before the next major move begins, it often does everything possible to shake out the people with the weakest stomachs. That is why a 30% drop, brutal as it feels, does not automatically mean the damage is over. Bitcoin has a long history of making people think the worst has passed, only to roll over again. Relief rallies happen in bad markets all the time. Sharp bounces happen in bear phases. Fast recoveries inside larger downtrends are normal. They give hope back just long enough to create a new group of trapped buyers before the next drop begins. So yes, Bitcoin has bounced off recent lows. Yes, panic readings have spiked. Yes, extreme loss events have historically led to rebounds. But none of that guarantees safety. A wounded market can still rally. A broken trend can still fake strength. And a whale that has already proven it can move price can still hit the market again. That is why people are watching exchange inflows so closely. Bitcoin moving to an exchange does not guarantee immediate selling, but the market reads it as intent. It reads it as preparation. It reads it as possible supply coming to the order book. In strong conditions, that signal might get absorbed. In weak conditions, it becomes toxic. Traders front-run the sell. Bots react. Fear spreads before the actual selling even finishes. And when this starts happening again and again, the psychology changes. The market stops asking, "Was that the last transfer?" and starts asking, "When is the next one?" That is a completely different mindset. That is not confidence. That is tension. That is a market trading in anticipation of pain. Now add another layer. This drop is not happening in isolation. Crypto does not move in a vacuum. Broader risk appetite matters. Liquidity matters. Macro pressure matters. If markets are already nervous, Bitcoin becomes even more vulnerable. In those environments, traders do not need a huge excuse to de-risk. They just need a trigger. And a whale repeatedly sending coins to Binance is exactly the kind of trigger that can tip sentiment over the edge. This is why one wallet matters more in crypto than it would in deeper traditional markets. In a massive, highly liquid market, one seller can be absorbed. In crypto, especially during weak periods, one heavy participant can distort the entire mood. Not because they control the future by themselves, but because they arrive at exactly the wrong moment. They hit a market full of fear, and fear multiplies their impact. So what happens next? There are really three paths from here, and each one carries its own danger. The first path is the bullish one, or at least the least painful one. The recent washout may have already forced out enough weak hands. The realized losses may have already done the heavy cleansing work. The sellers may be exhausted. If that is true, Bitcoin can stabilize, reclaim important levels, and start rebuilding momentum. For that to happen, the market needs more than one green day. It needs proof. It needs to hold higher. It needs the exchange inflow pressure to cool off. It needs the whale activity to stop haunting every bounce. It needs buyers to show that they are not just bargain hunting for a quick flip, but actually willing to absorb supply. If that happens, the narrative changes fast. Panic turns into cautious optimism. Fearful traders who sold low start chasing back in. Short sellers get squeezed. Momentum funds return. The market starts talking about a reset instead of a breakdown. That path is possible, but it demands real strength, not just noise. The second path is the one many experienced traders worry about most. Not the violent crash, the slow bleed. This is the grind lower that destroys people psychologically, not because it is dramatic, but because it is relentless. The market bounces just enough to keep hope alive, then fails again. It drops, stabilizes, rallies, gets rejected, slides, and repeats. Weeks turn into months. The chart becomes a staircase of disappointment. Traders stop panicking and start decaying. Capital drains slowly. Interest fades. Volume weakens. Social media gets quieter. Enthusiasm disappears. This kind of market is vicious because it does not let you feel finished. A sharp crash at least gives you clarity. A slow bleed gives you confusion. Every rally looks maybe real. Every dip looks maybe overdone. Every month feels like maybe this is the turn. And that uncertainty can crush traders harder than one brutal flush. If Bitcoin enters that kind of phase, the whale becomes even more dangerous. Because in a slow, fragile decline, repeated exchange inflows act like pressure points on an already bruised market. Every time price tries to stabilize, new supply threatens to hit. Every time bulls try to build momentum, another shadow appears over the chart. That is how hope gets worn down. Not in one day, in layers. Then there is the third path, the outright capitulation crash. This is the most violent scenario, but sometimes the cleanest. Bitcoin loses a major support zone. Liquidations cascade. Fear explodes. The media starts declaring the cycle dead. Late buyers quit. Leverage gets destroyed. And price drives into a zone so painful, so fast, that it finally exhausts the remaining sellers. This is the scenario where Bitcoin does, in a short period, what the slow bleed would do over months. It front-loads the pain. That kind of move feels unbearable in real time. It feels like the end. But it can also create the conditions for the strongest reversal, because once panic has fully detonated, there is no one left to scare. The market becomes lighter. The sellers finish. Stronger hands step in. And the very violence of the move creates the foundation for recovery. The problem is that nobody rings a bell when that moment arrives. That is why this period is so difficult. Not because the scenarios are impossible to imagine, but because living through them is emotionally expensive. Everyone says they want volatility until volatility starts hunting their conviction. Everyone says they will buy fear until fear shows up wearing the face of another 20% drop. Everyone says they are long-term until the market tests what that actually means. So if you are sitting in this market right now, you have to be honest with yourself. Not with social media, not with the comment section, not with whatever prediction made you feel smart at the top. With yourself. Are you positioned for another leg down? Are you overexposed? Are you holding because you have a plan, or because you are frozen? Those are not the same thing. If you are using leverage in a market like this, you are standing too close to the fire. Fragile conditions punish leverage first. If you are all in emotionally and financially, every candle becomes a threat. That is not strategy, that is vulnerability. Surviving markets like this is less about heroic prediction and more about disciplined positioning. That means accepting uncertainty. It means scaling instead of lunging. It means understanding that bottoms are processes, not magic moments. It means resisting the urge to declare victory because of one bounce, or declare doom because of one flush. It means watching the behavior beneath the price, exchange flows, market structure, whether rallies are being sold or supported, whether fear is fading or deepening. And above all, it means understanding the role of psychology. Because markets do not break most people with data, they break them with emotion. They trap them at the highs with greed and force them out at the lows with fear. They make the wrong decision feel urgent. They make patience feel stupid. They make panic feel rational. That is why the transfer of wealth in markets so often follows the same pattern. From the emotional to the disciplined. From the impatient to the prepared. This whale story matters because it is exposing exactly how unstable sentiment already was. One wallet did not create all of Bitcoin's weakness. It revealed it. It exposed how much fear was already sitting under the surface. It showed how little pressure the market could absorb without stumbling. And that tells you something important. The market is not just fighting a seller, it is fighting fragility itself. So now the next moves matter more than the last ones. If the inflow pattern stops, if panic cools, if Bitcoin starts reclaiming important levels and holding them, the market gets a chance to rebuild. If the inflows continue, if every bounce gets sold, if support starts breaking with force, then the downside scenarios gain weight. And if we get another major shock while sentiment is already wounded, this can accelerate very quickly. That is why traders are watching the next transfer so closely, not because one transfer guarantees doom, because it has become a signal in a vulnerable environment. A signal the market has learned to fear. The moment participants begin reacting before the event instead of after it, the psychology changes. The signal becomes part of the market structure. And that is what makes this moment so important. We are no longer just dealing with price action. We are dealing with expectation, with reflex, with a market that has started flinching. Sometimes that ends with a sharp reset and a recovery. Sometimes it ends with a drawn-out bleed that makes everyone wish for the sharp reset instead. But one thing is clear, this is not a casual pullback anymore. Not with a 30% monthly collapse, not with billions in realized losses, not with late buyers capitulating, not with whale deposits repeatedly hitting the narrative at the worst possible time. Bitcoin is in a stress test right now, and stress tests reveal everything. They reveal who bought with conviction and who bought with borrowed confidence. They reveal whether support is real or just temporary optimism. They reveal whether the market still has strong hands waiting underneath or whether it needs more pain before true demand shows up. That is why the next phase matters so much. Because once a market enters this kind of emotional territory, the rebound can be violent, or the breakdown can become self-reinforcing. In other words, this is the zone where the market decides whether it wants to repair or punish. So do not let one green candle fool you. And do not let one red candle break you. Watch the structure. Watch the flows. Watch whether fear is peaking or just spreading. Watch whether the whale's shadow keeps hanging over the market. And most of all, watch yourself. Because in moments like this, the hardest chart to read is usually the one inside your own head. Bitcoin has survived devastating crashes before. That does not mean every holder survives them well. The asset can recover while badly positioned traders get destroyed along the way. That is the distinction people forget when they say, Bitcoin always comes back. Yes, it has come back before, but it does not come back in a straight line, and it does not rescue bad risk management. This is where discipline becomes the edge. Not hype, not hope, not pretending the pain is not real. Discipline. Because if this is the bottoming process, discipline keeps you from panicking out at the worst moment. And if this is only the beginning of a deeper decline, discipline keeps you alive long enough to take advantage of it later. Either way, the answer is the same. Control the emotion. Respect the risk. Stop treating uncertainty like an inconvenience. It is the environment now. The whale may have started the latest panic. But what happens next will be decided by something even bigger. Whether this market still has the strength to absorb fear without collapsing into itself. That answer is coming soon. And when it comes, it will not arrive politely.